as interest rates are going higher and higher, we got to now start really considering them as part of our investment analysis in cash secured puts. And that's what I'm going to dive into in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And so one interesting thing that's coming up now is a lot of people are talking about investing part of their portfolios in these high yielding cash accounts. For example, you can see that the Vanguard Federal Money Market Fund is yielding 5.06% now. Now just keep in mind guys that that's an annualized yield. You're not going to make 5.06% every 7 days. It's an annualized yield, and this is pretty much the equivalent of cash. It has a very low expense ratio, and you need a minimum of $3,000. And so, why does this matter? And it matters because, when you think about, the mechanics of a cash secured put, essentially what you're doing is you're agreeing to purchase stock at a future date, or purchase stocks at a future date for a particular company at a particular price. And so what you really need to do to avoid any sort of a major type of risk there is set aside the capital, or at least know that you will have that capital absolutely for sure available by that exercise date should you get exercised on it. Now, the only other thing that I would say there is that sometimes you do get exercised earlier than the date as well. So I always go into, if I'm going to sell a put, I always set aside the cash, so the cash secured portion, for that reason. Now, some of you guys are new to cash secured puts, and so let me just walk you through the sort of like decision tree. And I guess this is not so much of a decision tree as it is in like an events tree. And so what happens is you write the CSP after you do your analysis. And in the next section of this video, I'll talk about the analysis in more detail. But essentially what happens is you write the CSP, and then of course, you earn a premium. But one thing that a lot of people don't pay attention to is that if you're setting aside cash, you are also earning interest on that cash. Now, in the last 10 years, we've had low interest rate environments, and so it was pretty immaterial. You didn't really think about it. You knew that your overall earnings would be, some basis points higher because you were earning on that cash that you'd set aside, but you never really thought about it more than that. But now, when you're looking at the 5% interest rates, it really matters, and it could allow you to enter into certain positions that you may not necessarily would have entered into, knowing that or in the situations where the interest rates were not there. So, you have the potential to enter into other types of positions. And so what happens when you or after you've written the CSP? Well, there's only two things that could happen. This option is just binary. One is that it expires out of the money. So you write a $25 cash secured put, and at expiration date it's selling at $30. Well, nobody's going to sell it to you or force you to buy it from them for $25 when they can get the market to buy it from them for $30. And so it expires out of the money, and so your earnings are the premium and interest on the cash. Well, what happens if it's exercised in the money? Well, you have to have ensured that you priced the CSP in a way that you're now generating an acceptable return on investment. And essentially what that means is that when you wrote the CSP, and I will show this to you in the next slide, is that when you wrote the CSP, what you really did is you created sort of like a net purchase price, because what you did was, say you wrote the CSP at an exercise price of $25 and the premium was $6. Well, 25 minus the 6 means that you put an immediate cash infusement of net 19. That's the 25 minus the 6, so $19. And so, if you have a threshold of at least a 15% equity yield, then you want to make sure that the company that you wrote the cash secured put on at least makes $2.85 a year, somewhat predictably, so that if you were exercised on it, your real earnings was just the interest on the cash plus the earnings that the company earned throughout that option cycle, because you can look at it from the perspective of you effectively were exercised from day one, if you want to think about it mentally that way. And I'll walk you guys through it just to show you how I think about both of the binaries. And so let's do that right now. All right, so here is the free options yield calculator that you guys have access to. It's in the comments, or sorry, in the description of the video. Now, this is an updated link. So guys, just FYI, if you've downloaded the options yield calculator before, this is an updated link. And what I did was, I updated it for this right here, and I'll just color this, I'll call it orange or something. So this is the new piece that I've added, because we kind of have to think about the money market yields now as we consider cash secured puts. And so I'll walk you guys through this and just show you how it works. So there's effectively two things that could happen that I just mentioned in the previous slide, which was, you're either gonna not be exercised, and so you're concerned about what your annualized yield is if you're not exercised, but you also could be exercised, and so you have to consider what your equity yield is should you be exercised. And essentially what you want to do is you want to price this in a way where you make money no matter what, so you don't care which direction this goes. And the whole point of this is that, the share price right now on the security may be a little bit too high relative to what you're looking for. So for example, Foot Locker is currently trading at $25.36. If you're making $3 a share, which is what I think the EPS run rate is at the moment, and you could argue that, but let's just for argument's sake say that that's what the EPS run rate is. $3 divided by 25.36, let me just do that quickly, is 11.8%. So I like to invest in a way where I can get a 15% equity yield. So I cannot flat out buy the shares for Foot Locker right now. Okay, that's fine. Let me take a look at the options. Now, preferably, I'd like to just flat out buy the shares. This is why I like to look for price to earning ratios that are very low. But sometimes I'll buy lower equity yields, like an equity yield of 8 to even 5%, an equity yield, which is effectively 20 times earnings, 1 divided by 20, which is what gives you the 5. And I'll do that if the growth prospects for that particular company are very high. And so eventually I will get to that high equity yield, and it's very predictable. But that's really how I focus, and I think you guys should be focusing too. Like, really focus on that equity yield. What is it today? What is it going to be tomorrow? Foot Locker, I think it's not necessarily a high growth business, and so I would want to look to see if I can get a higher equity yield today. I can't do it based on the current share price, and so that's why I've walked into the analysis of cash secured puts and covered calls for this particular opportunity. And so the first thing I would do is enter the ticker symbol and the exchange, and you can do that right here. And then the second thing that I'll do is I'm going to enter the money market rate. And so I'm not going to put in the 5.06 that you see being quoted with the Vanguard rate. And the reason why I'm not going to do that is because if you notice, this exercise date is June 20, 2025. What makes you think that the money market rate will be 5.06 throughout that whole time period? I don't think it is. These are short-term instruments, and they float with the interest rate. So yeah, I mean, they might raise rates, but they also might reduce rates if we enter into a tougher than expected recession. And so, the one thing that everyone should have learned over the last couple of years, or at least the last 3 years, is that nothing is predictable. You have to be careful, and so you really have to focus on the downside. And so I'm setting this at 3.5%. I could even set it lower. I could set it at 3%. It doesn't matter, right? Or yeah, let's just go with 3%. Okay, so what happens? Well, you enter in the exercise date, enter in the strike price, and I just try to do the at the money covered call. It's currently trading at $25.36, so around $25 is referred to as at the money covered call, and then the premium for that is $6. Now here's the interesting thing: you don't just earn $6 of a premium, you also earn the cash interest earned, because you have to set aside the cash so that if you are exercised on the option, you have the money available to purchase it. Now, don't just assume that you need the money at this date, because I have had stocks exercise, or I've had cash secured puts exercised before the date. So you always have to have the cash in the account. That's why it's called cash secured and not just writing puts, right? That's the reason why I don't write naked puts. And so because that is the case, what'll end up happening is you'll have your $25 set aside. and you'll also generate a $6 premium. Now, the way that I do the analysis is I assume that the $6 is going to go somewhere else. Like I'm going to invest it somewhere else. It's going to be used elsewhere. And so when I calculate the cash interest earned, I'm only calculating it on the $25. So you can see here, B13 times the money market rate, and all I'm doing is I'm annualizing it, because if you just take $25 and you multiply by the 3%, 0.03, you get 75 cents. But remember, you're holding it for 706 days, so you really got to do that 75 cents divided by 365 days times 706 days. And I just did that quickly on the calculator. I got $1.45, and that's exactly what you have here. And so it's annualized. And what does this really mean? Now, if you were thinking about holding the $6 in the account, yeah, you'll earn more interest on it, but you can deploy this. This is free, and so you can deploy this anywhere else. You can purchase more securities. You can do whatever you want. This is a simple way to look at it. Some people look at it from a net perspective. They're like, I'll invest $19. And the premium will be the additional amount to get me up to that 25. Fine, you can look at it that way as well. But I'm just trying to keep it simple for you guys. You enter into a contract with a strike price of $25, have the $25 available on day one, and that's what we do the analysis on. And the $6 is just your earnings, and put it wherever you want. Okay, so now what ends up happening is your yield actually is effectively throughout the life of the cash secured put, you're going to generate $6 plus $1.45, and then you're going to divide that on the capital that you used to enter into this transaction, effectively the capital that you deployed, which is just the cash that you set aside, which is the $25. And so on a current yield basis, you made 30%, because you're getting $6 on day one, but throughout the life of the option, you're also making $1.45. So that's $29.80. Now, current yield is not really a good term, because half of it is current, the other half is being earned throughout the life of the option. So this is actually not a good term, and it doesn't really matter anyways, because we're going to annualize the whole thing anyways. Okay, and so now what you need to do is, what we really need to do is we really need to look at the annualized yield, which includes the cash interest. And so what this complicated formula is really doing is it's just taking the sum of what you earned, which is the B14, B15 is just the $6 plus the $1.45. So that's your $7.45. You divide that by your initial investment, which is the $25. Okay, and so now that would give you the $29.80, right? You can do that on your calculator. So 6 plus, and I'm just doing it right here. So 6 plus 145 gives me 745, divided by the 25 gives me $29.80. And then what I'm going to do is I'm going to divide that by the number of days it took to earn that 29.8%, which is 706 days. Right, and so I divide that by 706, so that gives me 0.0004, whatever, and then I multiply that by 365, and that gives me my annualized yield, which I've just calculated with my calculator at 15.4%. So let's see if that's close. Exactly, 15.41. Yeah, 15.406. So 41. And I mean, if you extend this out, you'll see the 406. Oh, 408. I guess it still continues to round. But the point is that you're not actually earning 29.8. You're earning 15.4 because you own this over 365 days. Remember, annualized returns are just whatever the item is divided by your cost basis, but it's also multiplied by 1/1. There's another part to the formula that you never see, and so that 1/1 is that piece of the formula where the assumption when you're calculating the return is that it's being generated over 1 year, but you can very clearly see that we're not generating this over 1 year, we're generating it over multiple years, and so you do have to annualize that. And so if you do not get exercised, you have generated an annualized 15.41%. Okay. Now, what happens if you do get exercised? Well, you kind of have to look at it a little bit differently. And this is the way I like to think about it. So, what you have effectively done is you've deployed $25 or set aside $25, but you got back $6. So here's where that net type thinking comes into play. And I never have really done a good example of explaining this on the channel. And so I do want to explain this to you guys. And what it is you've entered into an agreement once again for $25, but you immediately get $6. So you have entered into a situation where you've deployed a net $19. Now, at the end of the contract, the shares are trading below $25 per share. Right now they're trading at $25.36, but by the end of the contract they're trading below $25 per share. Okay, so in that case, what ends up happening is you actually are on the hook to buy the shares for $25 per share, which you already knew when you went into the options contract. And so you effectively purchased the options for $19 per share. Now, here's the thing. Throughout the life or throughout the time that this company has been operating, you had purchased the shares for $19 per share, and this company has been running at an earnings rate of $3 per share. So really what has happened is that you've been earning $3 per share on the deployment of $19 effectively since day one. So really what you've been doing is you've been earning since day one of your investment. And so this is what I mean when I originally said that you can even think of the net purchase as the earnings that you've earned from day one if you assume that you're going to get exercised anyways. But the point that I'm making here is that here's how cash secured puts can become a win-win no matter what. Now, the one thing you have to be sure of, or as sure as reasonable, is in the EPS run rate. Now, Foot Locker may not necessarily in the current environment be a good example. This company could very well earn $1 per share next year, or it could go back to earning $4 per share. It really depends on how they execute. Now, I believe that you're probably safe at assuming that they're going to do around $3 a share, but that's not necessarily 100%. So you do have to consider that. And so there is some risk here. There's risk with everything, of course, right? But this is how it works. And so you guys have access to this model now, and I really hope that it helps you out. Now, just let me know if you guys have questions, any kind of concerns. If you want to hop on with me, hop on our monthly calls. More than happy to help you guys. And so I'll leave it there. And you know what? The other thing that I do want to point out is that the Q&A series on this channel is probably the most important content that I have available. And if you haven't seen the rest of the Q&A series, you can get access to that right here.